Hello, Eric. How are you?
Morning, Adam. Good. How you doing?
Good. I'm back home. You're back in Santa Monica?
Yep.
Okay, good. Thanks for doing the solo last week. I was in Georgia and Tennessee doing some marketing, meeting with some of our accounts. Also did a presentation to the CFA in Chattanooga, Tennessee. So that was fun. And this is all part of my Roaring 2020s tour. Taylor Swift had her the Eras tour, so this is my Roaring 2020s tour. And one of the themes that I try to emphasize is the idea that it's amazing how well the U.S. economy has done, notwithstanding Washington, despite Washington, despite regulations, taxes, fiscal policies, Fed policies. The U.S. economy continues to do well. Every now and then we have a recession, some of them caused by the government, some of them are our own fault because of speculative excesses, which might be related to government policy. But again, it's amazing how well the U.S. economy continues to do. This expansion has lasted for a while. We bottomed with the last recession was the two-quarter recession. It was actually the two-month recession back in 2020. And we've been making new highs, not ever since then, but after we fully recovered, I think it took about 20 months to do that. We then continued to make new record highs in the economy. So that's impressive. The other theme of my presentation is maybe it's time we worried less. I guess in our business we can't do that. We always have to worry. But could it possibly be that on balance more things will go right than go wrong for the economy and the stock market? It certainly has happened lots of times before, given that recessions, relatively speaking, are infrequent and relatively short compared to expansions. And the same thing for bear markets. Bear markets are relatively infrequent and relatively short compared to bull markets. Having said that, Eric, I guess there's a few things to worry about now. I'm not particularly worried about the fact that the Fed probably is done lowering interest rates. That just, I think, speaks to the fact that the economy is doing pretty well, and that inflation is close to 2%, but it's really not quite there. But then we've got this issue with tariffs. What are your thoughts on that, Eric? Anything new that you read over the weekend relevant to this issue?
We had the 25% on steel and aluminum. I must admit, it's kind of nice that we're not just talking about Fed headlines every day for once. Um, but steel and aluminum are like quick out of the gate ones. They happened in Trump 1.0 as well. They're not huge sources of imports, and Canada is a big source of both. So, potentially that gets resolved just in whatever North American trade agreements arise, which should happen, relatively quickly relative to other countries. So we'll see. I mean, we expect the tariffs to be announced. We'll see how they progress.
Yeah, I mean, it's kind of inconsistent with what he did about a week ago, right? I mean, or time flies, so I forget if it was a week or 2 weeks ago, but he threatened both of them with 25% tariffs, and both of them responded by saying that they would respond to his call for them to do more in the interests of U.S. national security. In other words, our borders, putting more personnel on the northern border than the southern border to stop illegal immigration. And then he said he'd stop for 30 days. And here we are. And he's back slapping a 25% tariff, not on everything, as was the original threat, but on steel and aluminum. So it's an ongoing situation. I think you and I and everybody should get neck braces because it's you never know what he's going to do next or say next. And we don't even really know what the point of tariffs is at this point. Is it just to negotiate better trade deals? Is it national security? Is it to raise revenues? I'm thinking that the idea of raising revenues maybe he's cooling off to that. Maybe he's realizing that's not going to work all that well, and it creates a lot of uncertainty about retaliation. I was encouraged to, I was encouraged over the weekend and maybe on Friday to hear that they were talking about reciprocal tariffs rather than retaliatory tariffs. I know it's a semantic issue, but retaliatory tariffs is kind of what the Smoot-Hawley tariff was all about. America raised our tariffs, everybody retaliated by raising their tariffs, and it's kind of spiraled out of control. If we're talking about reciprocal tariffs, that's actually how we got out of the Smoot-Hawley conundrum. Cordial Hull, who worked as Secretary of State for Franklin Roosevelt, was assigned by Roosevelt to kind of stop the insanity of the Smoot-Hawley tariff, and he negotiated a lot of what was at that time called reciprocal tariffs. And reciprocal tariffs meant that, let's lower our tariffs in lockstep with each other. So I hope that's kind of what we're talking about here. That basically Trump is saying, you've always had a 10% tariff on us. We've had no tariff on you. Now we're going to slap on 10% on you, and let's talk about it and work it down to zero. So we'll see how that plays out. Besides the tariff issue, the question, of course, is how will it impact the economy, and how will the Fed pausing here affect the economy? Maybe we just before we jump into the charts, give us kind of your quick take on the employment numbers that came out on Friday, and maybe some of the other numbers. So just kind of an overview rather than specifics. We can look at the specifics in the charts. The economy's still doing all right?
Yeah. I mean, it was a pretty remarkable employment report, I thought, just across the board. I mean, if you told anyone 6 to 12 months ago that the unemployment rate would be at 4% in the first month of 2025, I don't think many people would have believed you. I thought most things looked good. And obviously we had some revisions that were pretty good for the past couple of months, but broadly, I mean, we're going to get slightly lower payroll growth because immigration is going to be less of a factor in Trump 2.0 as it was during the Biden administration. But we might be settling in at full employment for this year and the foreseeable future, which would be incredibly bullish just because people have jobs, but also helps workers gain skills, become more productive, earn better wages. So things look really good. We'll see how things progress, but we might even be getting manufacturing coming out of what's been a multi-year long rolling recession. And that could really help that section of employment as well. So it was encouraging. I think things looked really good.
Yeah, and I want to give you credit. I think it was when we were in December and we had the November employment numbers. You thought that when November, December, and January numbers came out, we might have an average of over 200,000, and you were wrong. You weren't bullish enough. What was the number?
Yeah, we're at 237 or 237,000.
Right. So and a lot of people focused on that weak January number. What's your thought on that? Anything special there? As you know, my motto, and I'm trying to teach you this idea that any data that doesn't support our story is bad data, or it's going to be revised. So tell us, is it bad data, or is it going to be revised, or what?
Yeah. No, as our local LA correspondent, there was a pretty substantial jump in workers who were affected by the fires. More people were out of work, just like not even part-time, completely out of work than any of the previous months last year where we had big hurricanes. So that definitely weighed on payrolls, we think, to some degree. So maybe we even had 250,000 average payrolls added over the past 3 months, but it also definitely hurt hours worked, and we can see that. We'll see that in the charts. But without the fires, I mean, we could have had another 180,000 month of payrolls added. So again, just a really strong January.
And the revisions that occurred, the big ones. Well, there was downward revisions in the payroll employment, right? And there was upward revisions in the household measure of employment. There's two measures of employment. Household measures the number of people with jobs, whether a person has one or two or three jobs doesn't matter. It's a head count of people who are employed either part-time or full-time. And then the payroll numbers is a count of how many jobs there actually are, part-time, full-time, et cetera. Both were revised, right? Just kind of go over the payroll was revised downwards. as was anticipated, and the household was revised upwards as we anticipated.
Yeah. So if you recall, like a month or two ago, the Census Bureau revamped how they measure immigration and found like 3 million, 4 million more immigrants over the past couple years. So 2023 and 2024. So this monthly employment report revised up the labor force and household employment to match that. So the labor force is now over 170 million Americans. Household employment jumped pretty substantially. But encouragingly, payroll employment was revised lower, but less than everyone thought last year when we had that 818,000 downward revision. Again, we kind of said we don't think it's as extreme. It'll probably get revised. So it was only just under 600,000 people, and that was for like April 2023 to March 2024. So it's very lagging. We have a number of payroll employment reports since then, but overall, we still have a supply and demand mismatch in the labor market where there's more demand than supply, which some people thought that might actually go away in reverse after these huge revisions. So we got the revisions. Everything still looks the same. Yeah.
Yeah, I mean, the pessimists were going around focusing, they tend to look for the data that supports their story. It's human nature, I suppose. We try to be balanced about it, but because they do such a good job of finding all the bad stuff, we tend to focus more on what they're missing. But they were focusing on the household employment and full-time employment based on the household survey, and pointing out that it was kind of in a coma, that it was flatlining and weak, and that it didn't corroborate what the payroll data was showing. So I guess there's a little bit of a compromise here in terms of the data. The household survey is stronger, the payroll level is weaker, but the 3 months certainly suggests that things are quite good. And the unemployment rate is based on the household survey, and that's down to 4%, which is why I guess the bond market sold off on Fridays. The perception that, well, wait a second, does the Fed really need to lower interest rates anymore if its mandate of keeping the unemployment rate down is being met? Okay, why don't we open it up for some look-see on the charts. All I got to do is find them. There it is. Okay. All right. Eric, just kind of just breeze through some of these charts. I'll butt in every now and then.
Yeah. So unemployment, no one talks about the SOM rule anymore when we were at 4.3% and ostensibly climbing. We think, we're settling in anywhere from, the high threes to the low fours in terms of unemployment, expecting full employment from here.
Okay, this is what you were saying before about over the past 3 months, the average increase in total payroll employment is 237,000. As we're about to show, a lot of as you said, it was a really good payroll number, employment number report. Let's do it that way. I'm getting there. Because a lot of the indicators support our story, things are getting stronger. I mean, that certainly looks like the 3 month average is getting stronger. The 12-month average is no longer falling, and both of them are at least consistent with what we had before the pandemic. So that looks fine. This basically tells the same story for the private employment. This is what you said before on which one were you looking at, the light blue or the dark blue here?
Yeah, so the light blue is I used to work full time. Now I work part time because of the weather. And the dark blue is I'm just not at work because of the weather. So that definitely impacts payrolls. You're just not at work, you're not getting a payroll. And it beat all those hurricane months last year. So really substantial impact from the LA fires. And I don't think the GDP impact is going to be so extreme. There's been some modeling here that suggests on a county level, it's not even that high. But, I think those workers will come back next month and that should support payrolls.
Yeah, I don't know why the Bureau of Labor Statistics has this tendency to dismiss hurricanes and fires as having an impact on the labor market when they themselves put out the data here that suggests that it very likely did have an impact. Anyways, figure four, is that a fire impact?
Yeah, I definitely think so. So we had this big drop off in hours worked. I think it's definitely has to do with the fires. They've been pretty low, for the past several quarters, but I think this will rebound. One of the things that this does is it kind of weighs on our income proxy and how we expect, personal income to grow and therefore consumer spending. This is probably an adverse shock from the fires, and I'm not sure it's actually going to weigh on consumer spending all that
Yes.
much. So
And it should rebound here in
yeah.
February, right? By the way, folks, we don't have any cues in our Q&A folder here. I opened it up a little late, so you should be able to see it if you want to ask any questions about anything you like. By the way, Eric, remind me we should talk about some of the other excitements in the market. Like, I mean, bonds is kind of like falling asleep, which is not nice for a change. As you said, same idea with the Fed. Maybe if we don't have to worry about the Fed, the bond market will settle down a little bit here. But we should talk about gold and Bitcoin. So figure five, tell us the story there.
Yeah, so this is the birth death adjustment. And when it goes up, it adds to payrolls. When it goes down, it removes from them. They're trying to account for new businesses that might get missed in the payroll survey. And we saw business applications started to jump a few months ago, and we think they're going to continue to rise under Trump 2.0 in a more favorable business environment. And we just started to get the birth death adjustment ticking up last month. So that could be a tailwind for payrolls for at least the next few months in our optimistic outlook, the rest of the year and 2026, et cetera. But it's a support for sure.
Well, what's fascinating is we've got charts that look at this red line, and we'll kind of update it in tomorrow's morning briefing or this afternoon for those of you who like to get the advanced copy and read it. But if you take the 12-month sum of the business applications, it's been running over 5 million on a 12-month basis consistently since the pandemic, which is really quite impressive. It really shows that a lot of people, for one reason or another, decided to start their own businesses, and it's been running at a rate of 5 million. Think about that. If each one of them just employs one person, that's 5 million a year. So it's kind of a mind-boggling number. It really speaks to the entrepreneurial spirit of Americans, and perhaps one of the more important facts that is widely overlooked in why America is exceptional. People really do want to get rich and be independent. Don't want to work for a company. They want to work for themselves, and so it's exciting, I think. I mentioned before that there's some other indicators here that show the economy actually improving. Even though the payroll number was weak, we did see that payroll employment diffusion index actually popped up here on a 3-month basis. The payroll employment goods, we've been pointing out that despite high mortgage rates, construction employment all-time record high, because there's still a lot of construction in the housing industry, though it's clearly down, but there's lots of other construction of manufacturing facilities to build semiconductor plants and things, semiconductors and things like that. Manufacturing has been weak, and a lot of that is probably you would think is productivity, but as we'll see in a second, manufacturing has actually been one of the weak areas of productivity in our economy since China joined the World Trade Organization. And we're thinking the productivity is going to improve and certainly improve in manufacturing with the technologies we have available to make people more productive in that sector. This is the Purchasing Managers Index for manufacturing, and it was basically below 50 for about 2.5 years, and now it's sticking its head up above 50. And we suspect this is the beginning of better things for the manufacturing sector in the U.S. This is another payroll employment diffusion index for manufacturing, and that's encouraging. Um, well, well, actually, yeah, we'll pass on these other charts. You can read all about it in the morning briefing today. Um, this one was kind of interesting. You want to kind of go over that one, Eric?
Yeah. So last month in the December data, there was a lot of focus that the hiring rate fell. And so, especially from the doomer and doomer adjacent community, some consternation that, no one can find a job, hiring is falling. And I thought the flow of employed workers to unemployed, so like people actually losing their jobs, plummeted to like a historic low. And I thought that was more notable. And the fact that this month it kind of stayed quite low is pretty important. And I think suggests like people aren't being laid off. And you can find that in a number of other data points. But I think it's a good labor market, right? People don't get not laid off if things aren't looking too good.
And then this is just updating the data, the upward revisions. Now, the bizarre thing, Eric, is they just revised up the labor force and the household employment data by a couple of million people, but they didn't go back and kind of distribute it before. So in other words, it's almost like a break in the data, right? They basically said we're not adjusting previous months. We're just showing you what the level is now that we found these people. Is that correct?
Yeah. So the payrolls data will get spliced up over previous months, but the household survey will just do a one-time adjustment and then keep going from there.
Yeah. What's your conclusion about the foreign-born versus Americans who are born here? I think you made a really good point, and that is the natives. There a lot of them are retiring, and that's what. Whereas foreigners, that's not the case. Is that kind of the big insight there?
Yeah, I've actually seen a lot of charts floating around that immigrants are the only people getting employed since the pandemic or a little bit before. And on a net basis, sure, there's kind of not a lot of growth in native employment, but it's because we had a huge wave of retirements. And then there's still a lot of inflows of people finding new jobs. It's just net, it's kind of remaining the same. So
Yeah.
foreign employment has jumped, like on a percentage basis, it surged from 27 million to 31 million. But overall, it's going from 18% to like 20% of total employment. And still like natives are the bulk of it. So everyone's finding a job regardless of.
Yeah, I think on Twitter there was or X there was a post that got really excited to uncover the fact that a lot of the employment's been foreign-born rather than native-born, and it got Elon Musk's attention, and he reposted it and wrote, "Wow!" And I guess when we have a chance, we should set him straight on it if we can. That about this idea that actually a lot of native-borns are retiring, and we're still hiring a lot of native-borns. Yeah, pass on that one. I think we covered it pretty well. Why don't we why don't we open it up for Q&A, and I'll let you field the questions. Look like we've got a fair amount of questions.
Okay, the first question's on tariffs. Do we have updated views there? I mean, we kind of touched on it early on, but
Yeah, I think our view is. I mean, you tell us what you think, but I'm thinking that the focus right now is on what I discussed before, which is reciprocal tariffs. You look around the world, and if people have tariffs on you of 5, 10, 20% or more, and you don't have any tariffs on them, you say, okay, well, we're going to slap the same tariffs on you. And if you don't like that, let's negotiate. We don't like tariffs. I think that's more the focus right now. I'm not getting the sense that Trump is really focusing on raising revenues at this point, though he clearly needs revenues. Maybe he's waiting to see how much money the Doge committee manages to find and save on the outlay side. But that's kind of my spin on it. Do you want to add anything to that, Eric?
no.
Okay, keep on going.
Next one from Cagdis. Ed, what do you make of Scott Bessent's verbal guidance over the past week where he's focusing on the 10-year yield as opposed to the Fed funds rate?
Mhm.
Do you think this works like James Carville times in the past and caps the bond yield? Or do you think do you think these efforts from Doge and Bessent work for the bond market?
Kagas, thanks for asking because we should. It was a very important development that we really should discuss. So let's discuss it. And Basically, Eric and I are very happy. We now have an insider at the U.S. Treasury. We wrote a piece saying that there's a bond vigilante and King Trump's court. I think that's kind of the spin we've had is that there's a similarity between now and early Clinton when Robert Rubin and James Carville warned Clinton that he was too ambitious in his fiscal plans and that it would lead to deficits that the bond market wouldn't tolerate. James Carville said if he was reborn, he'd want to be reborn as the bond market because it's so powerful. But it's never really been more powerful than it is now, right? Because there's so much more debt out there and it has to be refinanced, and there's more that new that has to be financed. And so I think Scott Bessent was basically saying that he's spoken to Trump and convinced him that that they really shouldn't bother trying to beat up on the Fed. That what they really needed to do was focus on placating the bond vigilantes. He must have pointed out to Trump that look, the Fed actually did lower rates by 100 basis points, and meanwhile the bond yield went up 100 basis points. And guess what? The bond market, to a large extent, matters at least as much, if not more, to financing a lot of credit demand and refinancing demand. So yeah, we think this is a very big deal. Besant is turning out to be one of us, somebody who's understands markets, has kind of lived through a lot of these things, and has sort of a market perspective on policy making, which is a good thing. He also, what did he do with regards to bills versus bonds, Eric?
Yeah, he just kind of left them unchanged, which, maybe he'll
The
change.
issue, the issuance, right?
So bills are going to, stay slightly elevated as a percentage of
Mhm.
overall bond issuance. So
Yeah,
he wants to keep the market, under wraps. I
yeah,
think Trump actually the following day said he thought the Fed was right to pause at last meeting. So I think the Sen has definitely gotten to him.
yeah. That's a good thing. You want to pick up Jim's question here? I think it goes back to gold and Bitcoin.
Yeah. So Jim asks, some pension boards are asking about investing in crypto, Bitcoin. Is there an avenue to participate in digital currencies outside of just investing in Bitcoin or other coins? So obviously digital payments will be a thing in the future, one way or another. Thanks.
Yeah, actually, I sit on a board of a charitable organization, and I actually brought up the subject. I'm not a big fan of Bitcoin, haven't been, and very sad about that because I guess if I figured it out earlier, I could have at least gone from 10,000 to 100,000 or 50,000 to 100,000. Uh, and now maybe it's going to go to a million. Who knows? We're kind of thinking that micro strategy, or now what is called strategy, will screw it all up for everybody by leveraging up the leverage in this whole thing. And maybe at some point something will blow up there. But yeah, I brought up in our board the fact that maybe we should just take a small position in it. And so we had our advisor look into ways to do it where you don't have to have a digital code and remember the code and worry about cybersecurity issues. Well, I guess you're always going to have to worry about cybersecurity issues, even if you own Bitcoin indirectly through a mutual fund. But there are, Wall Street's basically legitimized Bitcoin by having all these mutual funds, and now governments are legitimizing them by having the sovereign wealth funds investing in Bitcoin. So I think having a small position is all right. I think we're actually getting more excited about the potential for gold because think about it, if Bitcoin does blow up, gold's going to go up. And the world's not going to get to be a friendlier place. And one of the reasons gold has gone up consistently here is a lot of central banks in the axis of evil, Russia, certainly China, uh, Iran, ever since the United States froze the assets of Russia when they attacked Ukraine, bad actors have said, well, we don't really want to have dollars that can be frozen up by the U.S. Let's own physical gold, and so that there seems to be a lot going on there. So, yeah, we'll be at 3,000 here. In the next few days, the way things are going, we're making another new high. up almost $50, and it's probably going to go higher. So, Jim, I'd rather have a position in gold than Bitcoin, but maybe you want to have some Bitcoin just so you're following it. You agree with that, Eric?
Yeah, I mean, if you're kind of bullish on the entire ecosystem or like think payments will be a thing, you can kind of go the exchange route. Like Coinbase is a publicly traded stock. It's like buying CME or SIBO or something. And you don't have to actually have exposure to crypto. So, I mean, there's ways to play it. There's ETFs now, there's whatever. So,
Yeah, maybe you should, when you have a chance, put it on your to-do list to write a story along those lines. That would be good.
well, I saw Trump's like campaign manager joined the board of Coinbase. I bought more immediately. I was like, okay,
Oh,
that's
okay. Well,
uh,
it is very newsy related. I mean, it's when Trump spoke during his campaign at the crypto convention, basically made a U-turn and said he wants to be the world's crypto center. I mean,
mhm.
it went up. The Bitcoin went up when mutual funds legitimized it. So it's certainly not quarterly earnings reports. It's just kind of out of the blue statements by various financial players that they're legitimizing the concept. So I guess you got to go with the flow, even though I have an uneasy feeling about Bitcoin. Why don't we take one more question, Eric?
Okay. This one from Chip is good. The increase from 163 to 170 million workers is notable, given current GDP per capita around $82,000. That's like another 600 billion in GDP. What do we think?
Well, they are going to have to factor that into GDP, right, Eric? I mean, it's not like all these revisions just happened in the Bureau of Labor Statistics and the Bureau of Economic Analysis, which just does GDP, just doesn't pay any attention to those numbers. So there could be an upward revision in GDP, and that's kind of where we'd be happy with that in terms of the potential impact on productivity.
Yeah, I mean, I think the way it's calculated, it might go to GDI. It might
Yeah.
be recorded as incomes as opposed to like, the product that was happening, like products that were made in production already happened, and can be recorded. Either way, it's bullish for growth. And the way these kind of revisions tend to work is they happen kind of all in the same trend, right? So downward revisions in one area tend to follow downward revisions in another. So we think it's probably bullish for growth, and then output might be revised up, probably will be. So productivity over the past few quarters or past couple of years, probably actually stronger than we thought or actually saw in the data. So it's good. Yeah.
Yeah, and it's another example of how the pessimists focused on gross domestic income and how weak it is relative to GDP, and they said that's a more accurate number.
Mhm.
And these revisions say, no, actually, that's not the case. Let's just take Michael's question here about
Yeah.
uh, Trump suggesting that the U.S. debt might be lower than reported because of fraud in the Treasury. Any idea what he is talking about? I mean, we almost need like a Trump channel just to monitor all the news he generates and commotion he generates. I think it's pretty reasonable to believe that the debt is the debt, and it's accurately measured in terms of what the government owes. But Eric, that's another thing we should discuss. Is somebody pointed out to me that the gold that the U.S. owns is priced at $32 an ounce. Is that correct?
Hmm.
Yeah. So why not price it at its correct price and then use that to pay off some of the debt. The problem is that debt is so much larger than that would yield that even that wouldn't necessarily work. I think Trump also had this idea that if we bought Bitcoin, if the government bought Bitcoin and it went up a lot, that he could use that to pay off the debt. I think he's got a problem. I think we've got a problem in that it's going to require some pain to reduce the deficit. There's going to be we'll see what's left over with outlays. I'm actually optimistic that they might be able to come up with $100 billion in outlay cuts per year, which is $1 trillion over a 10-year period, and that would help to slow the increase in the deficit. So we'll see. It's a soap opera. It's never ending. It's always interesting, and we'll see how it plays out. Eric, thanks for joining me, and we'll see everybody next week. Thank you, everybody.
Thanks, everyone.